Linda Martinez sat in her kitchen on a Tuesday morning in March, staring at a Social Security statement that would haunt her for the rest of her life. She was 62, exhausted from decades of nursing, and had just filed for her benefits the week before. Her neighbor, Carol, stopped by with coffee and casually asked when Linda planned to claim. "I already did," Linda said, smiling. Carol's face went pale. "You didn't wait," she whispered. That single question unraveled everything Linda thought she knew. Over the next hour, Carol explained what Linda had missed, and the number was staggering. By claiming at 62 instead of waiting, Linda would lose over $100,000 in lifetime benefits. One decision. $100,000. Gone. Linda's story isn't unique. Every day, thousands of Americans make Social Security decisions based on myths, half-truths, and advice from well-meaning friends who don't have all the facts. The stakes are enormous. We're talking about money that will sustain you for 20, 30, even 40 years of retirement. Today, we're counting down the top 10 things I wish someone had explained about Social Security sooner. These aren't dry policy points. These are the real-world truths that separate a comfortable retirement from decades of regret. Each one could save you tens of thousands of dollars. Let's start the countdown. Coming in at number 10 is the earnings test trap, and it caught James off guard. James claimed benefits at 62 but kept working part-time at his consulting firm, earning $40,000 a year. 6 months later, he got a letter from Social Security demanding repayment. He'd exceeded the earnings limit, and Social Security was clawing back benefits. In 2023, if you're under full retirement age and earn more than $21,240, Social Security withholds $1 for every $2 you earn above that limit. James learned this the hard way. He assumed he could claim and work without penalty. Wrong. The earnings test is real, and it bites. Number 9 is the spousal benefit secret that Karen and Tom discovered too late. Karen never worked much outside the home. Tom was the breadwinner. When Tom claimed his benefit at 66, Karen assumed she'd just claim her own tiny benefit based on her sporadic work history. 2 years passed before a friend mentioned spousal benefits. Karen was entitled to up to 50% of Tom's full retirement benefit, significantly more than her own. She'd left thousands on the table simply because nobody told her to ask. Here's the kicker: you have to apply for spousal benefits. Social Security won't automatically give you the higher amount. You must know to request it. At number 8, we have the divorce loophole, and it's a game changer for millions. Susan divorced after 23 years of marriage. She rebuilt her life, started a small business, and never looked back. At 64, a coworker mentioned that Susan might qualify for benefits based on her ex-husband's record. Susan laughed it off. They'd been divorced for 15 years and barely spoke. But the coworker was right. If you were married at least 10 years, you can claim on your ex-spouse's record, even if they've remarried. Your ex doesn't even need to know. Susan claimed divorced spouse benefits and received far more than her own work record would have provided. She had no idea this existed. Number 7 is the widow's windfall that saved Margaret's retirement. Margaret's husband, Paul, passed away suddenly at 68. They'd both been receiving Social Security, but Paul's benefit was significantly higher. Margaret was devastated and terrified about money. At the funeral, Paul's brother, a retired accountant, pulled her aside. "You can switch to Paul's benefit," he said. Margaret had no idea. As a widow, she could claim 100% of Paul's benefit if it was higher than her own. She made the switch and saw her monthly income jump by $800. That's $9,600 a year. Over 20 years, that's nearly $200,000. This single rule kept Margaret afloat. Number 6 is the tax torpedo, and it blindsided Robert. Robert retired with a decent pension, some investment income, and Social Security. He assumed Social Security was tax-free. It's a government benefit, right? Wrong. Robert filed his taxes in April and discovered that up to 85% of his Social Security could be taxed as ordinary income. His combined income, adjusted gross income plus half of Social Security, pushed him into the taxation zone. He owed thousands more than he'd budgeted. The thresholds are low. For married couples filing jointly, if your combined income exceeds $44,000, up to 85% of benefits get taxed. Robert wished someone had warned him before he retired. Coming in at number 5 is the file and suspend myth. For years, financial gurus touted file and suspend as the ultimate Social Security hack. George and his wife, Ellen, planned their entire retirement around it. George would file for benefits at full retirement age, then immediately suspend, allowing his benefit to grow while Ellen claimed spousal benefits. They'd read about it in magazine after magazine. But when George walked into the Social Security office in 2017, the clerk shook her head. That ended in 2016, she said. Congress killed the loophole. George and Ellen's strategy evaporated. The lesson? Social Security rules change. What worked 5 years ago may not work today. Always verify current rules. Number 4 is the Medicare trap, and it cost Diane a fortune. Diane turned 65 in June but kept working with employer health insurance. She thought she didn't need Medicare yet, her coverage was great. She ignored the Medicare enrollment notices. A year later, Diane retired and tried to sign up for Medicare. That's when she learned about the late enrollment penalty. Because she didn't enroll during her initial enrollment period and didn't have creditable employer coverage properly documented, she faced a permanent penalty on her Part B premiums. 10% added for each 12-month period she was late. For life. Diane will pay thousands more over her retirement because she missed a 7-month window. Number 3 is the break-even illusion, the myth that ruined Linda's retirement, the woman from our opening. Linda did the math. If she claimed at 62, she'd break even by age 78 compared to waiting until full retirement age. I probably won't live past 80, she told herself. So she claimed early. Here's what Linda missed: break-even analysis assumes you'll die on schedule. It ignores inflation adjustments, compounding, and the real risk, living longer than expected. Linda just turned 76 and is in excellent health. Her doctors say she'll easily make 90. Every year past 78, Linda loses money compared to what she could have had. The break-even point isn't the end of the story, it's just the beginning. Number 2 is the do-over provision, the escape hatch almost nobody knows exists. Remember James from number 10, who got hit by the earnings test? 6 months after claiming, James learned about Form SSA 521, the withdrawal of application. If you're within 12 months of claiming and you repay every cent you've received, you can withdraw your application and restart later as if you never claimed. It's a literal do-over. James crunched the numbers. He'd received $9,000 in benefits. He had the savings to repay it. He filed the withdrawal, repaid Social Security, and waited until his full retirement age to claim again. That decision will net him over $60,000 in additional lifetime benefits. The do-over saved his retirement. And now, the number 1 thing I wish I'd known about Social Security sooner. This is the insight that changes everything, the truth that puts all the other 9 into perspective. It's the secret that financial advisors charge thousands to explain, and it's the reason Linda cries when she thinks about her decision. The number 1 truth is this: Social Security is not a single decision, it's a longevity insurance strategy, and timing is everything. Let me explain what that really means, because this is where people's lives change. Every year you delay claiming between 62 and 70, your benefit increases by roughly 7 to 8%, guaranteed, adjusted for inflation, for the rest of your life. Think about that. Where else can you get a guaranteed 7 to 8% annual return with zero market risk and full inflation protection? Nowhere. This isn't about break-even points or gambling on your death date. It's about protecting yourself against the single biggest financial risk in retirement, living too long and running out of money. Social Security is the only income stream you have that's guaranteed to last your entire life, no matter how long you live, and it increases with inflation every year. When you claim early, you're not just accepting a smaller check, you're locking in decades of reduced purchasing power. When you delay, you're buying the strongest longevity insurance available. Let's make this concrete with real numbers. Meet David and Susan, both born in 1960. David's full retirement benefit at 67 is $2,500 a month. If he claims at 62, he gets $1,750, a 30% cut. If he waits until 70, he gets $3,100, a 24% boost. That's a difference of $1,350 per month between claiming at 62 versus 70. That's $16,200 a year. Over a 30-year retirement, assuming even modest inflation adjustments, that's a difference of well over $500,000. David's decision isn't about math, it's about security. But you're thinking what everyone thinks: I can't afford to wait until 70, I need money now. That's where the bridge strategy comes in. This is how sophisticated retirees actually handle Social Security. Instead of claiming early, you use other assets, savings, 401k withdrawals, Roth conversions, to bridge the gap from retirement to age 70. Yes, you're drawing down assets. But you're doing it strategically to purchase the maximum guaranteed lifetime income available. Think of it as spending $50,000 from your IRA over 8 years to buy an extra $16,000 a year for life. That's an annuity no insurance company can match. For married couples, the strategy gets even more powerful. Here's what Rick and Jennifer did. Rick was the higher earner, his benefit at 70 would be $3,200 a month. Jennifer's maxed at $2,000. They retired at 64. Jennifer claimed her benefit at 67, her full retirement age, giving them $24,000 a year to live on. Rick waited until 70 to claim. When Rick turned 70, their household income jumped to $62,400 a year from Social Security alone. And here's the genius: when Rick eventually passes away, Jennifer will step up to 100% of his benefit, $3,200 a month, for the rest of her life. They maximized survivor protection. Let's talk about the inflation shield, because this is huge. Every January, Social Security benefits get a cost of living adjustment based on the Consumer Price Index. In 2023, benefits increased 8.7%, the largest jump in 40 years. That COLA applies to your benefit amount. If you claimed early and locked in $1,750, you got 8.7% of $1,750. If you waited and locked in $3,100, you got 8.7% of $3,100. Same percentage, but a difference of over $100 per month in the adjustment alone. Higher base benefit means higher inflation protection forever. Compounding matters enormously over decades. Now let's address the elephant in the room: health. People say, if I'm sick, I should claim early. Sometimes that's true. If you have a serious chronic condition and your doctor genuinely believes you won't make it to average life expectancy, claiming early might make sense. But here's what most people get wrong: they overestimate their health risks and underestimate their longevity. Studies show people are terrible at predicting their own lifespan. Even people with health issues often live into their 80s and 90s. And if you're married, remember, the decision isn't just about you. It's about your spouse's financial security after you're gone. A larger benefit means a larger survivor benefit. Here's where it all ties together: the mistake cascade. This is what happened to Linda. She claimed early because she was tired. That triggered the earnings test when she did consulting work, forcing her to repay benefits. Her reduced benefit meant lower COLAs every year. When her husband died 3 years later, she couldn't switch to his benefit because her widow's benefit was calculated based on his early claim, he'd also claimed at 62. 2 early claims cascaded into a lifetime of reduced income. The difference between what Linda receives now and what she could have received if they'd waited. Over $2,000 a month. That's $24,000 a year. That's a car. A dream vacation. Medical care. Security. Let's revisit the earnings test from number 10 with new context. Remember, if you claim before full retirement age and keep working, Social Security withholds benefits if you exceed the earnings limit. But here's the nuance almost nobody knows: those withheld benefits aren't lost forever. When you reach full retirement age, Social Security recalculates your benefit to account for the months you didn't receive payments. Your benefit goes up slightly. It's not a perfect trade, you still lose some value due to time and inflation, but it's not the total loss most people assume. Still, the better strategy? Delay claiming if you're still working. Don't trigger the test at all. Back to the divorce loophole from number 8, but with a strategic twist. Helen was married to Mark for 18 years. They divorced when Helen was 52. Mark was a high earner, Helen worked part-time. At 62, Helen could claim on her own record or wait. At 67, she could claim a spousal benefit on Mark's record. But here's the power move: Helen claimed her own smaller benefit at 62, then at 67 switched to the divorced spouse benefit based on Mark's record, which was much higher. Because she was born before 1954, she could do this. Newer rules closed this loophole for younger folks, but if you're in the right age bracket, it's still available. Margaret's story from number 7 deserves a deeper look. As a widow, Margaret could claim survivor benefits as early as age 60, but at a reduced rate. She could also claim her own retirement benefit as early as 62. Here's the advanced strategy: Margaret claimed a reduced survivor benefit at age 60, giving her income immediately after Paul's death. Then at age 70, she switched to her own retirement benefit, which had grown to the maximum because she delayed it. This strategy, claiming one benefit early and the other late, gave Margaret income when she needed it most and maximum income later. Few widows know this option exists. Timing both benefits strategically can add tens of thousands. Robert's tax torpedo from number 6 opens a huge planning opportunity. Between retirement and age 72, when required minimum distributions kick in from IRAs, you have a golden window. This is when smart retirees do Roth conversions. You're not yet taking Social Security, so your income is lower. You convert traditional IRA money to Roth, pay tax now at a lower rate, and avoid the tax torpedo later. When you finally claim Social Security, your income from Roth withdrawals doesn't count toward the combined income threshold. You've dodged the torpedo entirely. Robert could have converted over 8 years and saved tens of thousands in lifetime taxes. Planning the order of withdrawals matters enormously. Here's a truth that saved Michael's life: if you're receiving Social Security disability benefits and you reach full retirement age, your disability benefits automatically convert to retirement benefits at the same amount. Michael became disabled at 58. He received disability benefits for 9 years. At 67, his full retirement age, those benefits converted seamlessly to retirement benefits. He didn't have to reapply or prove anything. And because disability benefits are calculated as if you claimed at full retirement age, Michael didn't suffer the early claim penalty. If you're facing a disabling condition before retirement age, Social Security disability insurance can bridge you to retirement without destroying your benefit amount. It's a lifeline. Number 16 is the windfall elimination provision, and it ambushed Teresa. Teresa worked 20 years in the private sector, paying into Social Security. Then she became a teacher in a state with its own pension system that didn't pay into Social Security. She worked 15 years, earned a nice pension, and assumed she'd also collect her Social Security based on her 20 years of covered work. Wrong. The WEP kicked in. Because she received a pension from non-covered employment, Social Security reduced her benefit by up to half of her pension amount. Teresa's expected Social Security benefit of $1,200 a month dropped to $400. She was furious. Millions of public employees get caught by WEP and its cousin, the government pension offset. Here's a secret that boosted Carlos's benefit: Social Security recalculates your benefit every year based on your lifetime earnings. Carlos retired at 66 and claimed his benefit. But he got bored and took a part-time job at 68, earning $30,000 a year. 2 years later, he noticed his Social Security benefit had increased. Why? Social Security averages your highest 35 years of indexed earnings. Carlos's recent $30,000 years replaced earlier low-earning years in the calculation. His benefit went up automatically. You don't have to apply or request it. If you work after claiming and earn more than one of your previous 35 years, Social Security recalculates. Keep working if you love it, you might get a raise. Rachel had no idea her 16-year-old daughter qualified for benefits. Rachel claimed Social Security at her full retirement age of 67. Her daughter, Emma, was still in high school. Social Security pays benefits to unmarried children under 18 or up to 19 if still in high school of parents receiving retirement or disability benefits. Emma qualified for up to 50% of Rachel's benefit until she graduated. That was an extra $900 a month for 2 years. $21,600 Rachel almost left on the table because she didn't know to ask. If you have minor children or a child with disabilities when you claim, check eligibility. This benefit is hiding in plain sight. Here's a barely known option that helped Frank: the lump sum. Frank claimed Social Security at his full retirement age but waited 6 months to actually file the paperwork. When he finally filed, Social Security offered him a choice: take monthly benefits starting the month he filed, or take up to 6 months of retroactive benefits in a lump sum and have his ongoing monthly benefit slightly reduced. Frank took the lump sum, $7,800, and used it for a medical expense. His monthly benefit was reduced by about $60, but he needed that cash immediately. Not everyone should take the lump sum, but if you're past full retirement age and haven't filed yet, it's an option worth considering. Beyond the 12-month do-over from number 2, there's another restart option: suspension. Once you reach full retirement age, you can voluntarily suspend your benefits and let them grow at 8% per year until age 70. Why would you do this? Maybe you claimed at 67 but then got a job offer. Suspend benefits, go back to work, and restart at 70 with a 24% increase. Or maybe your financial situation improved and you no longer need the income. Walter did exactly this. He claimed at 67, inherited money at 68, suspended his benefit, and restarted at 70. His benefit jumped from $2,300 to $2,870. That's an extra $570 a month for life. Deeming rules are confusing but critical. If you claim before full retirement age and you're eligible for both your own benefit and a spousal or survivor benefit, Social Security deems you to be filing for both and gives you the higher of the two, not both. Emily learned this the hard way. She claimed her own benefit at 63, thinking she'd add her spousal benefit later. Nope. She was deemed to have filed for both. She got the higher amount, but she couldn't layer them. However, if you wait until full retirement age, deeming doesn't apply. You can choose which benefit to claim first and switch later. This is why timing to full retirement age is so important. Patricia checked her Social Security statement online and found a problem: 3 years of earnings were missing. She'd worked those years, paid taxes, but Social Security had no record. Errors happen: employers report incorrectly, names get misspelled, records get lost. Patricia dug out old W-2s and pay stubs, submitted them to Social Security, and got her record corrected. Those 3 years boosted her estimated benefit by $200 a month. That's $2,400 a year, $72,000 over a 30-year retirement. Check your earnings record every year at ssa.gov. If you spot errors, you have 3 years, 3 months, and 15 days to correct them. After that, it's nearly impossible. Dual entitlement sounds like a bonus, but it's a limitation. If you qualify for your own Social Security and a spousal benefit, you don't get both full amounts. You get your own benefit first, then Social Security tops it up to the spousal benefit if that's higher. Nancy worked part-time and qualified for $700 a month on her own record. Her spousal benefit based on her husband's record was $1,200. She thought she'd get $1,900, both combined. No. She got $1,200 total. Her own benefit plus a $500 spousal top-up. Understanding dual entitlement prevents false expectations and helps you plan accurately. Most people think student benefits for adult children ended decades ago. Partly true, but there's an exception. If your child is disabled before age 22, they can receive benefits on your record for life, regardless of age. Gina's son, Marcus, has autism. He qualified as disabled at age 19. When Gina claimed her retirement benefit at 67, Marcus began receiving a disabled adult child benefit equal to 50% of Gina's amount. He'll receive it for life as long as he remains disabled and unmarried. This benefit supports millions of families but requires medical documentation and approval. If you have a disabled adult child, explore this before you claim. It could provide crucial lifelong support. When Arthur developed dementia at 74, his daughter Laura became his representative payee. A representative payee is someone Social Security appoints to manage benefits on behalf of someone who can't manage them due to mental or physical incapacity. Laura could deposit Arthur's checks, pay his bills, and manage his finances legally. Without this, Arthur's benefits would have been vulnerable to exploitation. If you have an aging parent or a family member with cognitive decline, consider becoming their representative payee before a crisis hits. It requires an application and occasionally a medical statement, but it protects vulnerable beneficiaries from financial abuse and ensures bills get paid. Jean received a letter that made her sick. Social Security claimed she'd been overpaid $14,000 over 3 years and demanded repayment. Jean had reported her income correctly, but a computer error led Social Security to pay her too much. Now they wanted it back, threatening to withhold her entire benefit until the debt was cleared. Jean filed a request for reconsideration and a waiver, arguing the overpayment wasn't her fault and repayment would cause financial hardship. After 6 stressful months, Social Security granted the waiver. She didn't have to repay. If you get an overpayment notice, don't panic. You have rights. Request a waiver, appeal, or negotiate a payment plan. Don't let them take your entire benefit. Brenda was widowed at 61 and began collecting survivor benefits based on her late husband's record. At 64, she met Alan and they fell in love. Friends warned her, if you remarry before 60, you lose survivor benefits. Brenda waited. They married the month after her 60th birthday, preserving her survivor benefit. The rule is clear: remarry before age 60, you lose survivor benefits from your late spouse. Remarry at 60 or later, you keep them. For divorced spouse benefits, remarriage at any age ends eligibility unless that later marriage also ends. These rules force impossible choices. Know them before you say I do again. Love and benefits don't always align. When Leon retired at 62, he faced a 3-year gap until Medicare kicked in at 65. Health insurance was his biggest worry. He'd planned to claim Social Security early to help pay premiums. Then his financial advisor showed him the ACA marketplace. Because Leon's income would be low in early retirement, no salary, no Social Security yet, he qualified for significant premium subsidies. His insurance cost $200 a month instead of $1,200. This allowed Leon to delay claiming Social Security until 70. The ACA bridge saved his retirement strategy. If you retire before 65, explore marketplace subsidies. Lower early retirement income can mean cheaper health insurance, letting you delay Social Security for maximum benefit. Here's a quirk few notice: cost of living adjustments are announced in October and take effect in January. But the COLA applies to your benefit as of December, regardless of when you claim that year. Olivia was deciding between claiming in November or waiting until January. She worried she'd miss the COLA. Not true. The COLA is baked into the benefit formula. Whether she claimed in November, December, or January, the new COLA adjusted rate applied. However, if you're delaying to 70, claim in January of the year you turn 70, not December of the prior year. You max out at 70, there's no reason to claim even 1 month early. Timing within the year rarely matters, but January of your 70th year is optimal. Hardly anyone knows about the special minimum benefit, but it saved Ruth. Ruth worked low-wage jobs her entire life. Her calculated Social Security benefit was only $450 a month. But because she worked more than 30 years in covered employment, she qualified for the special minimum benefit, a floor designed to help lifelong low earners. Ruth's benefit bumped up to $780 a month. It's not a lot, but it's substantially more than her calculated amount. The special minimum hasn't been updated in decades, so fewer people qualify now, but if you worked 30+ years at low wages, check if you're eligible. It's a safety net built into the system that Social Security won't automatically tell you about. Stanley retired and moved to Costa Rica to stretch his dollars. He assumed his Social Security would follow him. It did, mostly. Social Security pays benefits to U.S. citizens living abroad in most countries, but there are exceptions. If you move to Cuba, North Korea, or certain other restricted countries, payments stop. Also, if you're not a U.S. citizen, additional residency rules apply. Stanley set up direct deposit to a U.S. bank account his daughter monitored, then transferred money internationally. He had to file annual life certificates proving he was still alive. Expat life and Social Security can work, but plan ahead. Understand the payment rules for your destination and set up banking accordingly. When Greg claimed his Social Security, he expected his wife and 2 minor children to each receive 50% of his benefit. That would have been a bonanza. But Social Security has a family maximum, typically 150 to 180% of the worker's benefit. Greg's benefit was $2,000. The family max was $3,500. His wife and 2 kids had to split the remaining $1,500, not receive 50% each. Each got $500 instead of $1,000. The family maximum prevents one worker's record from generating unlimited dependent benefits. If you have multiple dependents claiming on your record, understand the cap. It's not 50% per person without limit, there's a family ceiling. People confuse Social Security retirement with supplemental security income, but they're totally different. SSI is a needs-based program for low-income elderly or disabled people, funded by general tax revenue, not Social Security taxes. You don't need work credits to qualify for SSI, you need financial need. Gloria worked sporadically and had almost no Social Security benefit. But she had minimal assets and income, so she qualified for SSI, receiving about $900 a month. SSI has strict asset and income limits. If you have more than $2,000 in assets as an individual, you're disqualified. It's a safety net of last resort. If your Social Security is tiny and you're struggling, check SSI eligibility. It's separate, but it can provide crucial support. Victor applied for disability benefits and was denied. He gave up, assuming that was the end. Big mistake. Social Security decisions can be appealed, often successfully. Victor's friend convinced him to request reconsideration. Denied again. Then he requested a hearing before an administrative law judge. At the hearing, with medical records and testimony, the judge approved his claim. Victor received 2 years of back benefits, $38,000, plus ongoing monthly payments. The appeals process has multiple levels: reconsideration, hearing, appeals council, federal court. Most approvals happen at the hearing level. If you're denied any Social Security benefit, appeal. The initial decision is often wrong. Persistence pays, literally. Now let's see how all these pieces fit together. Meet Paul and Sandra, both 64. Paul's benefit at 70 will be $3,000, Sandra's will be $1,800. They have $400,000 in IRAs and $50,000 in savings. Here's their plan: they'll live on IRA withdrawals and savings from 64 to 67, doing Roth conversions each year to minimize future taxes. At 67, Sandra claims her benefit $21,600 a year. At 70, Paul claims his $36,000. Combined Social Security, $57,600 a year, inflation adjusted, for life. When Paul dies, Sandra steps up to his $3,000, giving her $36,000 a year as a widow. They've maximized longevity protection, survivor benefits, and tax efficiency. Social Security is complex. You've seen 30+ rules, exceptions, strategies, and traps in this video alone. This isn't something to guess at. Consider hiring a financial planner who specializes in Social Security strategy, preferably a fee-only fiduciary who doesn't earn commissions. A good planner will run scenarios, model your specific situation, coordinate Social Security with tax planning and withdrawal strategies, and potentially save you 6 figures over retirement. Yes, it costs money, maybe $1,500 to $3,000, but compare that to the $100,000 Linda lost or the $60,000 James saved. Professional help isn't an expense, it's an investment in your financial security. Don't go it alone on the biggest financial decision of your retirement. Before you make any decision, use the tools available. Go to ssa.gov and create a My Social Security account. Review your earnings record. Run benefit estimates at different claiming ages. Download publication 05100002, Your Retirement Benefit, How It's Figured. Use the Social Security Calculator to model scenarios. Read the AARP Social Security Resource Center. Consider purchasing software like Social Security Analyzer or Maximize My Social Security that runs hundreds of scenarios. Educate yourself. Social Security's own publications are dense but accurate. The more you understand before you claim, the better your decision will be. Information is power, and in this case, information is money, lots of it. Here's what to do right now. First, if you haven't already, create your My Social Security account today and verify your earnings record. Second, calculate your full retirement age and your benefit at 62, at full retirement age, and at 70. Third, consider your health, longevity, family history, and spouse's situation. Fourth, map out a retirement income plan. What will you live on if you delay Social Security? Fifth, talk to your spouse and align your claiming strategies. Sixth, consult a financial planner or at minimum run multiple scenarios with online tools. Seventh, decide on a claiming age based on strategy, not emotion or guesswork. Eighth, mark your calendar and claim at the optimal time. Don't rush. Don't claim just because you can. Let's return to Linda, the woman from our opening who lost $100,000. A year after claiming, Linda attended a community seminar on Social Security. The presenter explained delayed claiming, survivor benefits, and the do-over provision. Linda's heart sank as she realized her mistake, but then the presenter mentioned something: if you're within 12 months and can repay, you can withdraw and start over. Linda was 11 months in. She'd received about $14,000 in benefits. She had the money in savings. That night, Linda filled out the withdrawal form, wrote a check to Social Security, and reset her claim. She'll now wait until 70. That decision will recover nearly all the money she thought she'd lost. Linda's story doesn't have to be your story, but only if you act on what you've learned today. Here's the final truth: Social Security is the foundation of retirement security for most Americans. It's inflation protected, government guaranteed, and lasts your entire life. No other income source offers that combination. The decisions you make about when and how to claim will shape your financial reality for 20, 30, or 40 years. This isn't about squeezing every last dollar out of the system. It's about protecting yourself and your family against the uncertainty of the future. It's about making sure that when you're 85 or 90, you still have reliable income that covers your needs. The stakes are real. The choices matter. And now, you know what most people never learn until it's too late. Use this knowledge. Share it. And claim wisely.